After months of moving sideways, gold has finally broken out of its range and surged to a new all-time high. That's caught the media's attention and sparked the same old question. With gold at record levels, who is it really for right now? And with the stock market showing fresh momentum of its own, it's a fair question to ask. The truth is, when you look at today's macro risks and how the markets are actually structured, the answer becomes clearer than most people think. If you're interested in unique insights into the forces shaping our world and how they intersect with precious metals, you're in the right place. Subscribing is a small way to support the channel, but it makes a big difference in helping us bring fresh ideas every week. Thank you. Not long ago, gold was sitting at just $2,000 an ounce. Critics insisted it was overpriced and on the verge of collapse. Fast forward, and here we are. Gold has pushed past $3,600 per ounce and shows no sign of falling back to earth. Yet the media is still asking the same questions it did at every milestone. Who's actually buying at these prices, and what's the point? Who is gold really for? To get to the answer, we need to step away from gold for a moment and look at the equities markets. The stocks traded on exchanges like the NYSE and NASDAQ. The S&P 500, for example, moves over $200 billion a day, making it one of the most liquid financial assets on the planet, rivaled only by massive markets like US Treasuries. For most of this year, the S&P 500 was flat. Only recently has it started climbing again, but the rally comes with some serious caveats. On the surface, the numbers suggest the equity market is healthy and back on track. That illusion gives retail investors confidence, while gold's breakout makes it feel like investors suddenly have two great options. Stocks are rising, gold is rising, so why not both, right? Or maybe gold's rally is done, and it's time to pivot to equities. Sounds reasonable. But look closer at what's really driving the S&P 500. Year to date, the index is up just over 10%. Strip out the AI-driven tech names, and the strength vanishes. Nvidia alone now makes up 8% of the index. Add Apple and Microsoft, and 3 companies account for over 20%. Stretch that to the top 10 names, and they represent 40% of the entire S&P 500. We call that concentrated risk. And you can see the concentration more clearly by looking at indexes that strip out the megacaps or apply equal weighting. Take the Invesco S&P 500 Equal Weight ETF, ticker RSP. Its performance trails the traditional S&P by about 300 basis points. That gap tells you most stocks are lagging while a handful of giants pull the averages higher. The reason is simple. Money is pouring into the companies investors expect to dominate the AI boom. But here's a question. Are we really seeing a revolutionary wave of productivity or just another bubble forming? The story goes that AI will mint more billionaires and trillion-dollar companies than any innovation in history. Yet, analysts at Goldman Sachs have looked under the hood, and the math doesn't support the theory. AI stocks are up 17% this year, well ahead of the index. More than half of companies mentioned AI on their second quarter earnings calls, pitching it as game-changing. But fewer than 1 in 5 are actually reporting any bottom-line impact. And here's a reality check. ChatGPT launched at the end of 2022. If this technology is truly reorganizing balance sheets, we should have seen something in the numbers by now. The AI craze has warped valuations to the point of absurdity. Take Palantir trading at more than 200 times forward earnings. It's not sustainable. Are we in a bubble? Almost certainly. And like every bubble before it, the only real question is when it bursts. And when you expect a bust, the smartest move is diversification, finding a hedge that can absorb the shock. That's where gold comes in. So when the media asks who is gold for at these levels, the answer is simple. It's the institutional and retail investors who want resilience in their portfolios, especially when other assets are overpriced and overloaded with risk. Over the past 5 years, daily trading volumes have averaged around $149 billion, making gold one of the most liquid asset classes in the world, rivaling stocks and treasuries. That depth allows it to absorb huge inflows or outflows without distorting prices, a key difference from other markets that can seize up under stress. Even in times of crisis, gold stays liquid, which helps keep its volatility in check. And despite hitting fresh record highs, this run doesn't look finished. Analysts have had to raise their forecasts again and again, caught off guard by gold's strength in a period where, historically, it should have struggled. Normally, high interest rates push investors towards safe haven assets that actually yield income. Why hold gold when you can buy US Treasuries at 5%? Yet those who chose gold over bonds this year walked away with a gain of more than 38%. Crushing the so-called risk-free return. Gold tends to perform best when inflation is high and interest rates are low. And with the Fed quietly backing away from its 2% inflation target to ease pressure on a weakening labor market, we may be staring at a rate cut this month even as inflation ticks higher. It sets the stage for negative real rates, the exact environment where gold historically shines the brightest. For years, gold has been framed as the fear trade, something people buy when the world feels like it's falling apart. But that view sells it short. Gold isn't just about fear or protection, it's about balance. It offers a stable store of value at a time when other markets are distorted by hype and concentrated risk in untested technologies. And that's all we have for you today. Please remember to like, subscribe, and share with a friend. Thanks for watching, and we'll see you next time.